do these live webinars either on Tuesdays or Thursdays. This week we're doing Thursday. Today's topic is the profit and loss calculator. So we'll spend a lot of time here in the P&L calc. That'll be our main course. As usual, our appetizers will be kind of some of the other tools that we have available. And I always like to try to weave in kind of the topic that we covered the prior week and tie it all together. Last week we covered charts and technical analysis, so we'll use a bit of that today and then flow into the P&L calc. But for now, as we get going, this is the dashboard. So I logged in right before hitting go for today's webinar. You can see your couple things. First, you're greeted by our friendly green and white concierge here, tipping his hat. The other things in this join button that's glowing. So if you clicked on that, if you've never done that before, that's what leads you to the sign up page for these webinars that you're on today. So chances are you either got an email and registered, or you clicked on this link and registered. So we always update the topic before, of course, well in advance for the next one. So that way people can register ahead of time. So our concierge, what he's going to do is kind of welcome you to the platform. He's going to point you out to the main tools. We have the shortcut icons here, and we have shortcut icons down here, all of which I will cover. These are our most popular tools. IVolLive is how we run screens. Stock sentiment analyzer is how we analyze stock or index sentiment. P&L calc is how we measure the potential profit and loss of a trade, which we'll do today. Real-time spread scanner is a very powerful tool. This scans the market for 9 different options trading strategies. So we'll do a webinar on this very, very soon. It kind of deserves its own 45 minutes to an hour. Data download. So the feature's great for those that want to download data to do back testing. And then there's daily updates, which we will cover shortly. So again, you can access any of these by simply clicking on the appropriate icon. For any issues, questions, comments, to get going with a 7-day free trial, if you're not currently a user, we're at support@ivolatility.com. I'll put that in at the end too, so everybody has it. All right. So moving right along, daily updates, that's here under latest news. So what this will do is it combs the market 7 days a week. It finds interesting tidbits and morsels, and it puts that in here for your viewing pleasure. I typically read this in the morning, afternoon, and kind of before I sign off for the evening, because I always find interesting little tidbits in here that I then use for my trading ideas. Other things that we have over here, we have our IVX volatility monitor. So what this does is it shows you some of the more interesting names in the market with high volume. It shows you their current implied volatility and the change from day over day. So you can see kind of what's going on with these heavily traded names. And then it shows you the 1-year range, right? HL stands for high low. So for an example, SPX had a high of 31 with its IVX and a low of 11. So right now at 17, it's kind of, smack in the middle in terms of SPY. So that's a very cool, useful tool for some of the heavily traded names. Under news and research, this is actually editorial that we put out, in-house here at iVolatility. So if you click on last week's issue, which came out on Friday, what you'll find is whatever topic we were, very interested for that particular week. In this case, we were studying the Russell 2000. So the Russell 2000 has been interesting. We'll actually use that in today's example, because again, I like showing how kind of all of this dovetails together, right? Like the Russell 2000 dovetails with the research we were doing within IVolLive, which then details to an actionable trade we can make on the Russell 2000. And to analyze that, we need the P&L calculator, so we know our risk reward. But here, in this editorial piece, typically you'll see a few charts. Blue is spot price. So you could see IWM, Russell 2000 has been in a brutal downtrend. At the same time, implied volatility has been going higher. Historical volatility has ticked higher. So in this article, we were explaining kind of what that means and maybe how to take advantage of it, right? Under this how to play it subhead. So moving right along, once you kind of go through this dashboard, again, I'd like to spend probably 3 to 5 minutes a day within this dashboard every day that the market's open. The next thing I typically do is I go to IVolLive. IVolLive is again where you can run all these scans, or you can take a deeper dive on what you just read. So for an example, we were just reading about, IWM, the Russell 2000. So my next step would be to come to IVolLive and pull up an IWM tab. Now, I know this was a question we got, over our email line. So it's basically, how do you pull up a new stock monitor, or how do you pull up a new underlying stock, right? So let's say you came here to IVolLive and you had never used this before. What you would do is, you're gonna have your defaults, which is gonna be stock monitor, charts, SPY. But if you wanted something new, you would just hit this plus icon. And if you wanted a new stock monitor, you can click on add. And now here we go. We have 2 stock monitors. So anybody that was on the stock monitor webinar saw me play with like 5 stock monitor tabs, because I had each one run different scans. One was like volume, one was implied volatility, one was historical volatility, one was fundamentals, and one was dividends. And I had 5 different stock monitor tabs that we were running screens against. For today's webinar, that's kind of outside the scope. So when you want to get rid of a tab, you just hit the X. And then if we wanted to pull up IWM, the Russell 2000, you just pull that up. You can find the one you're looking for. So we cover options and futures at IVolLive. In this case, for this webinar, I want to look at the stock options. So I'm going to go with the NYSE. And here we go. The Russell 2000 populates. So a couple interesting things about the Russell. Another thing you could do is you could move it over here, right? Because I tend to go left to right. I look at the stock monitor. I have my charts ready to go. I tend to look at the SPY, every day, the VIX every day. And then, what I'll do is I'll go to some of our editorial, or I'll go from those daily news bites, and I'll pull up a new tab to do a deeper dive on whatever those topics were. So in this case, that was the Russell 2000. So what's been interesting about the Russell 2000, when you pull up a name within this view, within IVolLive, you'll get fundamentals here on the left. You'll get the chart over here on the right. This is where we spent the most of our time last week. We looked at, the chart. We looked at the different technical indicators available within the chart. And then beneath that, here at the bottom, you have the options chain of whatever instrument you have, which in this case is Russell 2000. So a couple interesting things here. You can always add to the fundamental side of the equation by clicking on this gear icon. And that holds true for really any view that you see within IVolLive. Anytime you see a gear icon, that means you can add fields, add or take away fields. So in this case, we have the 52-week high-low, we have the ask size, we don't have beta, but let's say we want to know how the Russell's trading relative to the S&P. So I can hit green on that one. We don't have change percentage, but let's say we want the day over day change. We do want to know the dividend. We do want to know IVP. So IVP stands for IV percentile. This is, me personally, one of my favorite measures, because it tells us how often the stock has been trading at a lower implied volatility, right? So if this number is very high, that means that this stock is under tremendous implied volatility relative to its 52-week trading range. So I like to have that. IVX, of course, is our bread and butter. That's implied volatility. That looks out over the next 30 days. And it tells you what the implied volatility is for this stock. This is kind of like the VIX, but many traders just follow the VIX, but the problem is the VIX is very broad-based, so what we want to know is what's the implied volatility per name, not just for the market, overall, not just for the S&P 500. And that's what IVX tells us. IVX change percentage, let's go ahead and add that. IVX change since open, that's also helpful, right? Because if it's a huge jump, that the implied volatility is happening like right now, almost in real time. And then these other things are already green, like open interest, option volume, previous close, price to earnings ratio, put volume, stock volume. If you wanted to know shares outstanding, you could select that. From here, we either hit apply, which would apply to just this tab for the Russell 2000, or we could do save as default, which means anytime we pulled up a new tab, all of those fields would populate, right? So just go ahead and hit apply for now. And we can see, we have our price for IWM. It's 170th share. It's down a little bit since the market opened. Its historical volatility is 14.38. Its implied volatility over here, IVX, is 21.55. So we could see that generally speaking, the Russell 2000 is trading with a higher implied volatility levels than what it's had over the past 52 weeks, and actually 30 days, right? The past 30 calendar days, because HV20 measures 20 trading days, which is the same as 30 calendar days. That's why IVX 30 and HV20 are apples to apples. Just a little side note there. Here's our options volume. So for today, 416,000 shares have traded. Option contracts rather have traded. Call option volume here, 52-week high low. So we could see at 170 a share, we're kind of on the lower end of the 52-week range. Price to earning ratio, beta, so it's a bit more volatile than the S&P 500, which makes sense because Russell 2000 is showing smaller names in general than the S&P 500. Here's our bid ask. Here's our implied volatility. So we can see implied volatility is up on the day, almost 2%. Here's our put option volume. So calls and puts are close, right? I mean, they're about 20,000 contracts skewed towards puts. Here's our earnings per share. Here's our IVP. So what this means is that, at this implied volatility level, 21, the Russell 2000 has been trading below that level 46% of the time, so I like something to me that's an outlier is when you see a name like we've looked at Activision Blizzard, we looked at Cisco the last couple of weeks, and these IVP numbers were like 90 or above. That meant that this implied volatility reading was rare. Something was going on. Put and call premiums were super inflated relative to what they used to be. So if you're a seller of options, that's very interesting, right? With IVP middle of the road around 50, you could be a buyer or seller of options. There's really no advantage either way. It's more, what do you think with the technical fundamentals, instead of the options pricing being skewed one way or the other. So kind of good teachable moment there. Here's our high low close, and then here's our overall open interest for all strikes. So this is a very liquid name in terms of IWM, which again is Russell 2000. Here's our market cap. So the value of all outstanding shares is right under, just shy of 40 million. And then here's our dividend, right? So there was a dividend that was just went ex-dividend on 9/26. So had somebody owned shares on 9/26, they'd be entitled to this dividend of basically 83 cents a share. So those are our fundamentals. Now, if we come over here to our technicals, let me expand that a little bit. In our chart, you hit on those 4 diagonal arrows, and that expands this view. So let's go here. So you'll see, by virtue of your subscription to IVolLive, you get up to 5 years of data for spot price, which is in blue. So you could see, Russell 2000 had this nice run into the spring of 2021. Then it kind of marched sideways, and then, it's just gone down from 2022, kind of stabilized, and now it's gone down further, right? So this tells you a lot with this 1 5-year view. It allows you to zoom out. You can also look at implied volatility in green. So you see, this inverse relationship, right? So when Russell 2000 crashed during kind of the depths of COVID, March 2020, when that price crashed, the volatility levels spiked, right? As you would expect with that inverse relationship. Now what you have is kind of this slow bleed out, right? This sideways action here. So what's great about this chart view is you're able to draw on it. So I showed everybody how to do this last week. We kind of played artiste on a few different chart patterns. But here, this is what stands out to me, since, let's see, May 16th, 2022, we've been kind of chopping in the sideways pattern. So what I'm going to look for on the 5-year chart is, when is IWM, when's the Russell 2000 going to break below support or above resistance? If we look at implied volatility, it's been, interestingly enough, it has been kind of in this, come here, pull back up my line. It's been in kind of this gradual downtrend, right? Nothing super exciting, nothing super crazy. But as what you'll typically find is when an equity kind kind of bounces within this, we call it range bound. When an equity is range bound, what you'll find is traders get disinterested and volatility kind of just bleeds out, right? Which is what we see here with implied volatility, which can be very interesting though, because if you want to put on a position, this means that your options price is going to be relatively low compared to maybe what it could be if implied volatility was also going nuts while share price is going down. It'd be much more expensive to enter a trade. So it's not a bad thing when you see a sideways pattern and when you see implied volatility bleeding lower, because it means it's going to be cheaper to put on, whatever ultimate trade you desire to do. So again, by virtue of your subscription, you can go as far back as 5 years. You can go as granular as 1 day or 24 hours. My favorite charts typically are 3 month, 6 month, or 1 year. I'm an intermediate term trader in general. I will do leaps and I will do short terms, but in general, my trades are like 60 to 90 days. And so I love these 3, 6, 9, and 12-month charts. So a couple of things, if we come here on the 1 year chart that caught my attention last week and this week, again, we have price in blue. So we could see this big downtrend here. I mean, look at that. That's pretty steep. This has been a really violent sell-off in a major indice like IWM. So this has been pretty brutal. I think it was down 7 days in a row, which is what originally grabbed my attention. So we could see here, like I just got a down arrow. At the same time that we had this kind of brutal, sharp sell-off, I also noticed that there was a big spike here in implied volatility, that green line. We can get rid of historical volatility for now. So we could see, and then there was a meeting, right? What we call a kiss. So there was a kiss of the two right here. Kind of draw that circle. So this is always very interesting because when I've written about this in the past and I've showed this on these demos, is when you see price and implied volatility kiss, it's often a catalyst, right, for the stock to either reverse its trend and move higher, in which case implied volatility goes lower, or continue its trend lower. But it's always a reason to dig deeper, right? And so that's what I started doing, and that's what we'll do in today's webinar. Before we go into the options chain, though, what also caught my attention here for this trade setup is if we eliminate share price, which is one of my favorite things to do, is to just get rid of share price, cut out all the noise, and only look at implied volatility. We can do that with this view. That red line wants to stay for us here, but what we can do is we can add any technical indicators we want. They're in alphabetical order. I wanted to add these two because these stood out to me, RSI and Bollinger Band. So what was interesting to me was, as I'm analyzing this is the implied volatility for Russell 2000, and you could see that it peaked above its upper Bollinger Band right there. So you could see we came above our upper Bollinger Band and we came almost to the reading of 70 on the RSI, which means when the implied volatility hits that level, it almost always turns lower, and when that turns lower, IWM almost always goes higher, right? So this was kind of like a signal to me, share price and implied volatility have kissed, and then we've gone above our upper kind of normal band for implied volatility, which means it could be interesting to put on a bullish bet for IWM. So then what I do is I come down to the options chain here, and I like to find an option and analyze, the probabilities, right? Because I want to know what's the probability that I'll be profitable. And then I take that trade and I run it through the P&L calc to get the exact numbers. So again, my trades typically 60 to 90 days. So just for the sake of this example, if we came out like 2 months to December 15th, 2023, here we are. Here is our various strike prices. Again, you have the ability here to look at all expirations, only long-term expirations, only the next 2, 3, or 4. I tend to look at all, but user's preference, dealer's choice. The mid price is always going to be right around the current share price. That's going to be your middle at the money strike, right? Which in this case is 170. And then you could choose to look at one strike, two strike. Five is typically my favorite because I'm normally around the money with my trades, but you could also do all strikes. And in an instrument like Russell 2000 is like a major index. It's like the SPY, it's like the NASDAQ. So you're going to have a ton of options if you want. But just to keep it simple, let's leave it at five. And we're going to show calls and puts because I'm interested in going bullish, but I don't know if that means I should sell a put. I don't know if that means I should buy a call. I don't know if that means I should do a spread trade. So I need further analysis, and I want to look at both calls and puts. So the next kind of step in my methodology is I look at the money, right? Because at the money has kind of the most ideal pricing, maybe if I'm selling, but also allows me to analyze, should I be going put, call, or spread? What I like to do is I like to pull up when you this is our recently revamped calculator tool. First thing you'll have when you pull this up is the options calculator. So this is if you wanted to play market maker and if you wanted to play around with different strike price, different expirations, different days to expiration, right? You could change this. Right now we have 71 days, which is right in my sweet spot. But you could say, well, what if there's only 51 days left? What would that do to the options price? And all this will update. But for now, when we're evaluating a potential trade, I like to go to the probability calculator. What that will do is we'll pull up the specific strike we're looking at, right? Which is the IWM strike 170 that expires on December 15th, 2023. Here's our dividend date, which we already looked at. We have 71 days to expiration. Here's our at the money volatility. So our IV is 2151, which is right. That's right in line with what we saw here. And now I want to know what kind of trade should I put on, right? And so for P1, I like to use the lower of the two prices. So here I would say, well, what if I sold the 170 put? What's the likelihood I'll get put? I'll earn $546 per contract, roughly, if I sell that. But again, what's the likelihood that I'll get put? For price two, I like to do the higher of the two numbers. So I typically do one or two strikes above my lower strike. So in this case, we'll keep it simple. We'll do 171. And what I want to know here is what's the chance that IWM will be above 171 at expiration? So hit confirm. So you can see there's only a 46% chance IWM will close below 170, which means there's only a 46% chance that I would be put. There is a 51% chance IWM will trade above 171, which is also very interesting because in this case, I could say, well, what if I wanted to buy this call option, right? It would cost me $7, but there's a 51% chance we'll be above 171. Well, what's neat about this, you can get a lot more granular on the P&L, but even with the probability calculator, you could say, well, there's a 51% chance we'll be above 171, but it's going to cost me $7 to get in that trade. So really what I need to know is what's the chance we'll be above 178, if I wanted to exercise that, because that's what it's going to cost us plus the strike price. And you can see there's only a 35% chance that IWM will expire above 178 on December 15th. And that doesn't mean the trade wouldn't be profitable along the way. So for an example, if IWM started going higher and implied volatility started going higher, this call option could be worth, $8 for an example. And you could still sell that call option and make a profit. What the probability calculator is telling you is the odds of the underlying share price hitting certain levels, right? The other interesting thing we could do, if we go back to the 171, we know that we're going to be, there's a 46% chance we'll be below 170, and there's a 51% chance we'll be above 171. So what this is telling us is it's highly unlikely IWM, right, the Russell 2000, is just going to stay where it is, right? There's only a 2% chance it's just going to stay between 170 and 171. So for me, that makes it very interesting to analyze a potential strat and a potential straddle and a potential strangle trade, right? Because with a straddle and a strangle, we'll make money if IWM goes higher. We'll make money if it goes lower. The only way we won't make money is if it stays the same, right? And so when I see something like this, like a 1, 2, anywhere from 1 to 5% chance that an equity will stay between two tight prices, like literally one strike price away, that almost always tells me to put on a straddle or a strangle, or at least evaluate it. So then moving right along, I'm going to stick with this strike and this expiration because it looks very interesting. Another thing I do, which is kind of outside the scope of today's webinar, but what I'll do is I'll come to this stock sentiment analysis tool, and I'll just quickly, run whatever equity I'm looking at through the stock sentiment analyzer. Because what I'm looking for is I'm looking for just affirmation, right? And so if I'm pressed for time, I like to look at this top row, which tells me, okay, the sentiment's moderately bullish, but it is volatile, which we know. It tells me the bullish rank. This ranges from 100% would be absolutely like rip roaring bull market. Minus 100% would be the opposite, a roaring bear market. 10%, positive 10%, we're right in the middle, which is perfect. Volatile ranks very similar. 100% would be extremely volatile, which I tend to stay away from because it's too tough to tell direction when we're at 100%. And then minus 100% is too boring because it's absolutely still. So there's nothing going on. So I like something in the middle, right? So 30% is perfect for me. We have 4 buy signals, 3 sell, 3 hold, right? This is kind of like Goldilocks. We're not too warm, we're not too cold. The other thing that the sentiment analyzer will do it'll give you kind of 2 different categories. One is going to be kind of the fundamentals of the stock, what's going on with the price action, which recently has been good. A green arrow means it's bullish. A thumbs up means doubly bullish. And then it's going to look at what's been happening with historical volatility. Right now, that's ambiguous, which is why it's a question mark. And then it's going to look at the call to put ratio, right? So right now we have a 0.47, which is suggesting that the traders have been loading up on puts and the name is oversold, right? Which is why we have a bullish green arrow. And then what you have beneath that is the technical indicators. We give you kind of 3 of the most popular. One is the exponential moving average, EMA for short. In this case, that is trading in a bearish formation, which is why you have a down red arrow. We also give the relative strength index. We use a 14-day measure, which is the most popular. And what this is saying is that it has turned bullish, but not heavily bullish, which is why it's a green arrow with a question mark. Here's the RSI. You can see now we've turned higher. And then we also have the chalk and money flow index, which is negative. So if we go down to that, you could see we've just had this heavy selling with IWM over the past 2 weeks, which is demonstrated here. While we're down here, you'll get basic data on the stock. You'll get open, high, low, close. You'll get the percentage change. You'll get dividend information. You'll also get the correlation. This is really cool. It's a shortcut to get correlation to major indices. So we have SPX, we have Dow, we have NASDAQ down here. We also show you the most common and popular historical volatility and implied volatility levels. So this is looking at the past 10 days. We have an HV of 17, past 30 days, HV is 16. And then you could compare these to implied volatility, right? So you could say, well, HV is 16, but looking ahead for 30 days is 21, right? So we have a 5 absolute percentage point difference, which means IWM will be more volatile looking ahead than it has been in the past. You could compare the 60-day, 180, etc. So really neat, useful information at a snapshot down there. And then also we have our price bands. So all this is doing is it's measuring the likely trading ranges of IWM, which we also did using the probability calculator. So overall, that's kind of supports my mildly bullish thesis. I'm not overly bullish on IWM, but I'm bullish enough to run some trades through the P&L calculator. So the way you do that is we have IWM. We put it in that little search box there. And then what you need to do is you need to scroll down to find the specific strike price that you are interested in. As a reminder, we're looking at something that expires, 60 to 90 days out. So what caught our attention was the December 15th 170 strike. So for now, I'll just click on the bid. When you click on the bid, it's going to assume you're selling, right? Because you're selling at the bid, you're buying at the ask. So here we have the fundamental information on IWM that we were just looking at, $170 a share. And then what we have is we have this action to take. So in this case, we're selling to open that December 15th, 170 put. We're going to earn $5.50 a share. Every option contract, here's one, trades in increments of 100 shares. So that'd be $550 in income. Here's the implied volatility, the delta, the gamma, the theta, and the vega for this specific option, right? And then here we have in chart format what our P&L looks like. So this blue line is our break even. So essentially, that's at like 170, here, a share for IWM. We're profitable on this trade as long as, IWM is at 170 or higher. We're not profitable on this trade if IWM goes below, right? Here we have our specific number. If IWM goes below 165, right, we start to show that we're not profitable, right? We start to show a paper loss on the trade. So you have the P&L in two different areas. You have it here in table format, and then you have it here in chart format. What's also neat is that you could kind of play around with this, because you could say, hey, if I put on this trade, it's great that I'm going to earn this income up front, and it's great that there's only a 46% chance I'll get put based on the probability calculator, but no options trades ever happen in a vacuum. So what's going to happen when volatility goes up 15%, right? So we saw this IV went from 21 to 36, and this whole P&L calculation will change for you. You could say, well, what happens when we're only 30 days out from expiration? What happens then, right? Because this time decay is really going to speed up, right? Our theta is now at 10.56. So since we sold it, we'd be earning this as long as, again, IWM stays above 170, right? If it goes below, then that's going to work against us. Other neat things you could do with the P&L calculator in terms of scenarios is you can go to these advanced settings, and then you could say, well, what happens if interest rates change? What if they go up, right? Because options prices are, sensitive to that. So you could say, what if going into this, right before our expiration on 12/15, what if rates go up to, 6%? And you could do that. And then you could, of course, just copy and paste that down to everything subsequent to that. And you could hit apply, and it's going to update what the options prices look like with higher interest rates. Other thing you could do is you come here to dividends. I like to do this, especially for like individual issues like Apple or Exxon is one we recently did. You say, well, what if the board raises the dividend, right, from 83 cents to 90, and leave all the dividend dates the same, right, and hit apply. And that's going to update the pricing for these options with either an elevated, or what you could do is you could reduce the dividend, and it could show what would happen. And then if you kind of get a little bit over your skis and get confused with what you've been doing, you could just hit reset, and this takes you back to the original P&L on this particular trade. And this is overall a trade I would like, because essentially I have I'm less than a 50-50 chance of getting put. Even if I do get put, my cost is 170 minus 550, right? So I'm really buying in at 164.50. When we looked at the chart and the technical analysis, the sell-off was, I think, maybe overdone and due for a breather. So I'm happy to buy IWM if it drops, for 164.50, which would be what we call my adjusted cost basis. Other neat things you could do here, like let's say I got a better price from my broker, I got $6 instead of 550. I can make that adjustment here, and my P&L will adjust. So overall, I think this would be a very interesting trade, right? Selling to open this put option. But other things you could do here too is we also want to look at maybe a call. Maybe we want to buy a put and spread trades, and you can do all of that from within the screen. So what's interesting is if you're doing your research and you're like, oh my gosh, everything I just looked at, I'm going to reverse, I want to go bearish now. Instead of selling this put, I want to buy this put. You can change that a couple different ways. So you can hit buy, and so now we're buying this put. Now we're bearish on IWM. We're saying, look, we think the sell-off is going to continue, and we're going to be profitable as long as IWM goes below 170. That's why this is in green. Here's our break even in blue. And then we're unprofitable if IWM moves higher, of course, which is why this is red. And that's that in table format, right? So if IWM drops to 90, we're up over $7,000 on this one contract. If IWM goes up to 210, obviously we've lost pretty much everything we've spent on this contract. We could also say, well, what if we bought 10, or what if we bought 10 of these put options, and this will update, right? 72 grand instead of 7 grand, and also the loss is magnified. So it's important to keep in mind. 7 contracts, so whatever increment you're interested in, and it will update the math. So that way, you have a very accurate potential P&L. So this would be if we are bearish, we can also go bullish. So we could say, hey, what if we want to buy the call, right? So we want to buy a call option. We saw that it's more likely than not that IWM will be above 171. Volatility, let's say, goes up by 10% between now and expiration. What does our P&L look like? So this is us buying the call option, right? And IV implied volatility is now 31. And that's kind of the way you would make money is if IWM started moving in your direction, started moving up, and implied volatility went higher, then what would happen is this call option would increase in value. And even if IWM doesn't trade, it doesn't end at say 178, which is really where you would need it to be if you wanted to exercise the option. With American style options, you're able to buy and sell those at any time leading up to expiration. So if we see an uptrend in price and we see an uptick in volatility, this particular strike will go up in value. And so if it costs 756, we could probably sell it for $8.50, $9 before expiration. And that's how we make a profit on the call option. Another cool thing you could do if your thesis changes. So right now we're bullish, we're buying this call, and it's going to cost us $756, right, per option contract. You could hit invert chart, and that'll take your thesis and just invert it, flip it upside down. So now we're selling this December 15th 170 call. And so in this case, what we're saying is we don't want IWM to go over 170. We want it to continue trading below 170. And as long as it does, when we sell this 170 call, we're going to earn that $753 up front. And the only way we lose that is if IWM goes higher than 170. So if it does, you could see where we start to lose money. But if it doesn't, we'll be able to keep this whole premium, right? And realize that profit at expiration. The other thing you could do that is very popular with this view is you could do a covered call. So all you have to do is click on add stock leg, and then click on this add stock to calculator once it loads. And what will happen is we have now turned this calculation into a covered call trade. First, we need to buy the shares, right? Not sell them. But let's say you've been sitting on a position. So this would be like if we established a position today. We'd buy 100 shares at 170.38 a share, and we'd sell this call against that, right? So what we're basically saying is we're going to give up any upside above 170 from our equity, but in exchange, we're going to reap the benefit of selling that upside for $753 today, right? So this is like a covered call trade that we put on today. But let's say you bought IWM, a year ago, and your cost basis was only, 150, right? You could put that in here, and all of this will update. What's cool about covered calls trades is delta. Like a lot of times, if you want to be delta neutral to the position, this will stack the delta on top of each other. And so you could say, well, if I wanted to be delta neutral here, I could actually sell 2 call options against my position with my cost basis of 150, and you're more or less delta neutral here. You're a bit over, at 17 points over, but more or less delta neutral. And what that does is it doubles your income, right? So instead of 753, you're going to make almost, like $1,500 selling 2 covered calls against your 100 shares. So that's another very useful kind of value add for this P&L calc when you're using covered calls. I love the ability of just looking at the delta very quickly in a non-complicated format. So that's another use case would be covered calls. Let's look at 2. Let's look at 2 spread trades, right? So let's do a straddle. Let's say we bought this December 15th 170 call. So in this case, we need, as is, when it's a naked leg, right? This is what we need to happen. We need the IWM to move higher. If we add an option leg and we say, well, wait a minute, let's do a straddle, because we know based on our probability calculator, IWM isn't going to stay stagnant. We just don't really know for sure if it's going to go higher or lower. We just know it's not going to stay stagnant. So a straddle and a strangle would be perfect in that scenario. So what we could do is we could come here to the 170, right? And instead of selling the put, we would buy the put. And here we go. So in this particular straddle, you can see the only way we're not profitable is if IWM stays stagnant where it is. But if IWM goes higher, our call option is going to explode in value, even though our put will expire worthless and won't matter because we'll make money on the call. And then vice versa. If IWM goes lower, we'll make money on the put option, right? So even though this call will expire worthless, it won't matter because we'll make our profit on the put. So you can see all along this price range, we're profitable. We're only not profitable if it stays where it is. And that's a straddle. Now, a strangle would be strangling the current price, right? Which is 170. So what we could do here, I guess the benefit, one of the main benefits to a strangle is you can get in a bit cheaper, right? Because you're not really as close to at the money as what we currently are. So you can see when I go to that 173, we drop from 7 and change to 5 and change. And then on the put, if I go lower in price, let's say to 167, right? That premium went down too to 447. So what we're doing here is, imagine 170, our current price, 170.39, is in the middle, and we're strangling that on the higher, and we're strangling that lower, right? 170 is in the middle, and then our strikes are for our calls higher, our strike for our put is lower, right? And the benefit to this is that it costs you less to get in a strangle in general. The downside is you need a more severe move in order to make a profit. So in this case, we need a severe move above 173 instead of 170. And then we would need a severe move below 167 instead of 170. All right. So it's cheaper to get in, but there's always a trade-off with options. The cheaper it is, kind of the more you need something to happen in general, versus the more expensive something is. And so this is another very interesting trade, right? Because essentially we're saying, look, we don't care if IWM goes higher or if it goes lower. We just don't want it to stay where it is. And again, thanks to our probability calculator, we're confident it's not going to stay where it is currently. So those are 5 different trading strategies: put, call, straddle, strangle, and covered call, using the P&L calculator. And again, we used the Russell 2000 as our example because that's what we covered in our editorial piece. I think I had it right here. Right here, our most recent editorial piece was on the Russell 2000. So we use that as our example to show how we draw the different conclusions, and then how we use IVolLive to then structure 5 different trades: put, call, straddle, strangle, and covered call. So now I just want to do a couple more things. I want to show this because we've recently updated and revamped our YouTube. So you can find videos like this here on our @IVolatility's YouTube, right? So here's a little welcome video we just recorded. You can come to these videos. They're all recently updated, relabeled. So it's very easy to find everything. So I'd encourage everybody to just, like, what I do is I follow us here at IVolTility's YouTube. So anytime we publish a new video, I get notified right away. So again, we're at IVolTility's YouTube. Please find us there. Other things that we've been doing recently, we've been posting in our Reddit channel. So when we find interesting setups or trade ideas or volatility ideas or anomalies, we've been posting them here. We're at r/IVolatility. And then we've also been posting in our, I guess, X, formerly known as Twitter. Here we're at iVolatility. Very simple, just at iVolatility. And we've been putting in interesting ideas, right, throughout the day. So if you visit any of these throughout the day, you're going to find interesting potential trading ideas, whether that's Twitter, Reddit, or YouTube, or even our LinkedIn. So please do follow us there. And then finally, if you're not currently a user, then we have our IVolLive. What we spent our time on today was IVolLive options. We do have IVolLive futures, and we do have Data Cloud API. So I love using what we did today to help study, analyze, and design trades. I love using our Data Cloud API to do backtesting on trading strategies. And then obviously for futures, do the same thing we just did with options, but it's just for the futures market. So if you're not currently a user, we offer 7-day free trials for all of these. Again, this is what we focused on today. IVolLive options, you would just hit free or sign up and register, and then you could choose. The basic difference is what I've been using for today's session is Pro Real Time. So here is access to everything: P&L, calc, spread scanner, data download. Advanced, you would get the P&L calc, which we covered today, but you wouldn't get the spread scanner, which we'll cover either next week or the week following. And then basic, you don't get the P&L calc or the spread scanner. So whatever is the best option for you, you could go ahead and subscribe there. And then also for anything, we are at support@ivolatility.com. And then let me see if we have any case for TLT. Let me make sure we don't have any questions here. Looks good. 2 different tabs. There are 2 tabs. We'll call calculators. Okay, great. So that's a very good question, Flavio. Thank you for that. So basically, we have these tabs. This tab right here, calculators. This is included no matter what level you're at, basic, advanced, or pro real time. So what these calculators do is, for an example, if we did IWM, click that. This is going to give you like the ability to play market maker, right? Because when you type in a ticker symbol, this could be IWM, which I just did. It could be Apple, it could be Google, it could be Meta, whatever. It's going to give you the at the money strike, which is 170. It's going to give you kind of the nearest term expiration, which is October 6th. In this case, the days to expiration, 1 day, 5 hours, 16 minutes. It's going to give you the implied volatility level, interest rates, overall, dividend date and dividend amount for this particular instrument, and then the frequency. And then what you could do is you could play around with this, right? So you could say, well, what happens if implied volatility goes from 26 to 30? And all of these prices will update based on however you manipulate that input. And then you could say, well, what if we go to 0 days out and implied volatility is at 30, right? And all of these prices will change. So options calculator is really, really powerful if you want to play around with hypothetical pricing for a specific stock and a specific option. And then probability calculator is useful if you want to weigh the probabilities of certain price points being hit. So in our webinar today, we said, well, what's the chance that, IWM will drop to 170? What's the chance it will go up to 171? This expiration is tomorrow, right? So the odds, probably won't be fantastic. Because we only have 1 day for this to all play out. But we did use at the money type levels, 170 and 171. If we did like 167, like 175, so a little further in and out of the money, you could see our odds get very poor because we only have 1 day left. But we could come down and we could find whichever expiration we desire. So in our case today, we focused on this 12/15. And then now the numbers get more interesting, right? Because we have 71 days to expiration. So these calculators are options calculator and probability calculator, and they're included in all subscription levels. P&L calculator, on the other hand, is where we were kind of spent the bulk of that second half of the webinar, and this is only available in the advanced and then the pro real time. So here and here. That's where the P&L calculator rests. So those are the 2 differences between calculator. And then also when I was here, when I was within the option chain view and we minimized the chart and the fundamentals, there's also this calculator icon. And this calculator icon is the same as this calculator icon, right? It pulls up the same things: options calculator and probability calculator. That's a great question, though. And then any other ones, feel free to shoot our way. We're always interested in feedback too. So I hope, everybody got a lot from this session, and we want to continue delivering these kind of meat on the bone type sessions for each one of these tools. So any feedback you guys have is also greatly appreciated. Let's see. You got it. My pleasure. My pleasure. Like I said, this is a great analytical tool. I use it all day, every day. So, I love to spread the good word here. And yes, what we'll do is we'll have our team edit this video, optimize it, get it on our YouTube, and then I'll have our team send a link out so everybody can replay it and watch it on your own time, because I know it's a very important topic, the P&L calc. And it was my pleasure to bring it to you today. So thank you guys very much for joining me on a Thursday. And until next time, happy trading.